Welcome, everyone. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journeys, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey everyone, welcome to another exciting episode of the What Matters podcast, where we delve into the insights and experiences of leaders in the financial planning industry. I'm your host, Mike Mershazadeh.
And I'm Ashley Ward.
Today we have the privilege of speaking with Darrell Cain, the founder of Cain Watters Associates, headquartered in Plano, Texas.
Darrell has over 40 years of experience in the financial planning and wealth advisory services industry, with a focus on serving dentists and high net worth individuals. He founded CWA in 1984, which has grown to manage over $4 billion in assets. Welcome to the show, Darrell.
Yes, thank you all. I appreciate you having me.
Well, it's fantastic to have you with us today. Let's get started. So, Darrell, let's start by delving into your journey and your origin story in the industry. Could you share with us and our listeners how you founded Cain Watters Associates and the experiences that have shaped your path and led you to establishing your own wealth advisory?
Yeah, so 40 years ago, as a solo practitioner in a room by myself, which still is astounding to me 40 years later, that we have 300 plus employees plus affiliates of another 300 employees, that all that started, by myself in a room. I had an experience of working at the time what was called Peat Mark Mitchell, now is KMPG, big CPA firm. Back then it was known as one of the big 8 firms. Now I call it the Final 4. And so I left that experience, and I had been the in-charge auditor on the Hunt family in Dallas, Texas, and worked on the silver crash of 1981. I guess that dates me. And learned all about tax planning, because the Hunts had over 600 entities, and they kept all their books on a tax basis. And we had to convert from tax to GAAP, or generally accepted accounting principles. So I learned my tax, and I had a chance to leave Peat Mark as a manager and go to work for a continuing education company that gave practice management to dentists. And I went there and stayed there 14 months, and I met 4 dentists that became my clients, none of them in Dallas, Texas, all over the country. And I offered to them to set up an investment seminar if they would invite 9 of their friends. So I had 10 people in each city, and I went to them, and I went every 3 months. And the first thing I did is I sat down for an hour on a Friday, 10 hours, and interviewed them, looked at their taxes, their financial planning, and then I found out what their problems were. And then instead of sticking with my agenda, I would rewrite. Back then, there's no PowerPoints, there's slides, that you put in a carousel. And, the old saying was, if you were more than 50 miles from home and you had a deck of slides, you were an expert, right? And I would then find out what they were concerned about. And the next day, I would tear up my notes that I had prepared for the seminar, and instead I would talk about what their needs were. After the second session, which was like 3 months apart, I presented them the opportunity for me to do financial planning for them. And my background, undergrad and graduate school at Baylor University, was with an MBA. And then my experience of being an auditor and principally learning tax is I then structured a program to present to them a financial plan. I was very blessed that out of the 30 participants, 27 of them signed up for my initial financial planning back in 1984. And I then started my business, which then grew out of referral out of those original 30 people. So that's kind of the origin. I had grown up, and my dad started out as a CPA. He eventually was a builder and many other things, and a realtor. And he always told me there's only so many hours in the day, and if you fill them all up with things that don't matter, then you get that result. So what I decided was I would set up a CPA firm, and what I would do is I would not do any accounting or bookkeeping, and I would not do any tax work, and I would not do any audits. So people would say, well, what kind of CPA firm is that? And I said, the only thing I want to do is give advice. And what I want to do is give advice to change the outcome of people's financial situation so that they could obtain the opportunity for what we would call, I guess, financial freedom. So that's what I did. And, being 27 at the time and not really having any experience investing their money, which of course is one of the tenets of allowing yourself to accumulate money. You got to know how money works. You got to know where to get the money. You got to put it in the right environment. Then you got to get a return on the money to allow it to compound. I started that process, and my initial thing pitched to my clients was, pay me my fee, and if you don't like it, I'll give you your money back, which I only had to do one time out of 30, which was, a guarantee to help people see that, hey, I'm here to serve you, not just to get paid. Started the business. First year, being a CPA, I kept track of time. I worked every day but 7 days. That includes Christmas. And I would travel the country to see these people because, they wouldn't come to Dallas. Had my first child, and I said, look, guys, I just can't come to all of you. And plus, they started referring business. So you have to come to Dallas. And, it's too expensive for me as I built expertise with attorneys and investment people, insurance, tax people. Too expensive to transport all those people to you. So they had to fly to Dallas once a year, which was expensive because they would leave their practice. And as I said, I targeted dentists. The reason I targeted dentists is they're smart. Mostly they own their own business, unlike physicians, which were back then in groups. They needed help and they were willing to listen. Whereas a lot of my physicians, when you're in a situation where you save someone's life, then of course you know everything, right? So then you don't know anything necessarily what you don't know about accumulating money. So I started that business and it grew. And I actually in 1986 taught a course for the AICPA on how to build $1 million financial planning practice. But 1986 was also the year that the Tax Act changed for the first time in forever. So, but I eventually had 600 participants, tried to create a study club of those 600 CPAs. Very frustrating because I would teach them everything I knew about how to obtain a client, how to accumulate money, but they weren't so successful. And so what I said, well, I'm going to change tax. And what I'm going to do is just build my own firm and add my own people. And now we're blessed. We have 40 plus advisors and a little over 3,000 dentists. We have approximately 10% of our clientele are not dentists, but they're people that own their own business. So that's kind of like our target audience. And we started out that way. 1987, we had the first experience of the stock market crash. Again, visiting with you, you're probably not old enough to remember that event. But that was very hard because I'd been in business 3 years. My clients as a group had accumulated about $500,000 because, that I started out with people that were just a little bit older than me but had no money. And they all had stockbrokers because, we didn't have access to mutual funds. We didn't have the sophistication that we have today. And on that given day in the fall of 87, we were about 60% in the stock market, but we had, 100 plus clients. They all had a stockbroker everywhere. I tried to teach my clients how to pick stocks. Of course, that was didn't go so well, but they each had a broker. And they would direct their broker to what they would buy, and they would do research. And the stock market fell approximately 40% that day. So that was a very difficult day for me, changed my life, because my clients with $500,000, like 250 in the market, lost like 60, 70 grand. So it was like a significant part of their money. And I know this doesn't sound too appetizing, but I went home that night and I got on the floor and I retched in the toilet because I was so upset that they had lost so much money that, they're having to grind out hour by hour. And it was so hard for them. And then I got up and made some phone calls to older people I knew that were in the investment business, brokers that I built relationships with. And they said, Darrell, this is really a day to take advantage of the situation. And I said, how so? He says, well, how much money do you have that is not in the market? And I said, oh, I don't know, half. He said, well, you need to go get the Wall Street Journal. Remember, we had no internet. Went down to DFW Airport at 5 a.m., got a Wall Street Journal as it's coming off the press, right? Went back, found all these stocks like General Motors that, had fallen by half and its dividend yield was 10%. Now remember, this is in the time period where the stock market, CDs were yielding 13% because, the interest rates were so high. So I went through that, got up on the phone starting on the East Coast because I had clients from East Coast to West Coast, started calling them, giving them 5 or 6 stocks to buy. They had to call their brokers. I then, of course, realized this system is not going to work long term. They all went in. Most of them took my advice, took their money, more than half, bought stocks that were down significantly. And between then and next December, we made about 50% return on our money. Not only the 40% we lost, but that came back up. We made more money. That started me on the process of helping people accumulate money, assets under management, which I would then hire a money manager. At the time, you only have 500,000, $1 million. You can only afford to hire one. And of course, he was a jack of all trades against all asset class. So that's kind of how the business started. That's how I first came to grips with, I needed a system where I could give advice to my clients where I didn't have to call each of them individually, where they didn't have to go through a broker. So I had to figure out a way to have uniform trades for everyone. And of course, being very savvy and informed. I mean, my first license, I was a realtor at 18 because my parents were realtors. And then the next thing, I had a CPA license at 21. And then the next thing I did is I took all my securities exams, 7, 24, 63, so I could set up a broker dealer, which I never did, but I wanted to have the licenses so I would know what people had to know to have those licenses. And so I went and I created, with this money manager I hired, a common pool trust fund at a bank where everyone could buy into shares of the common pooled trust fund, and then they could put their money in there, and then we could have one manager, so we'd have uniform performance. And of course, I would avoid front running my clients, because the one thing you can't do is give people advice for something that you're willing to own unless they first have the opportunity to buy it. So we had to eliminate all that, and then became aware of all the securities laws and all the registration. And then over the last 40 years, now that we started a bank, we have a broker dealer. Cain Watters is a CPA firm. We have a firm that is like a Costco for dentists. In other words, we buy their supplies and things. We do about $300-400 million in sales there. We negotiate the sales of their businesses between each other. Also became a certified valuation analyst, to help people value their business. So that's kind of the origin story, a little bit of the history of the firm. Kind of a long answer, but it kind of gives people maybe a perspective of where we came from and how we went about it.
Well, thank you. I appreciate you sharing that. Let me ask you this a little bit more about, your firm there. You had said that you had about 300 employees and about 40 advisors. How's that broken up there?
Well, we have, over time, I had to change my attitude. I always believed in, one of the questions you had is, what is one of the big lessons? And that's what you always put the big rocks in first. So the big rock was giving advice to our clients that they valued, as opposed to being a CPA who, I like to say, comes in after the battle is over, tallies up everything, and bayonets the wounded. That I didn't want to be that person. What I wanted to do is be the person that gave advice. So of the 300 people, we have probably 40 planners. We have probably 40 what we call associate planners. Those are young people. Generally, we'll hire them out of the big 4 accounting firms with 3 to 5 years experience. And then they train under our system that we developed on how to do financial planning. And they work, we have what we call pods. We have 12 groups with usually one of my partners, because I have 13 partners now, and then senior planners, newer planners. And with that, they have associate planners, CPAs that assist them in the preparation and delivery of the system. So I would say in total, we have about 100 people directly in the planning role. We also, over time, one of my dentists came to me one time, way back, and said, Darrell, you do a great financial full mouth restoration. We're talking dentistry now. But my hygienist at home, my CPA, can't figure out what you're doing or how to do it. So I really need you to provide me all my accounting. And one of the things we specialized in was creating partnerships between dentists. And, the most important thing in the partnership is, how do you get into the deal? How does the deal work while you're in the deal? And how do you get out of the deal? So the thing about how it works in the deal, you got to figure out, how do you split the money? That's the main thing partners want to know, is like, for what work I did, how do I split the money? So we created an accounting department. Likewise, we also created a tax department to prepare the tax returns. So now we prepare somewhere around 6,000 tax returns in all 50 states. We probably have 60, 70 employees directly doing tax preparation. We also, file all their property tax returns and city returns and every imaginable return that you could find in 50 states. And then we also do accounting. So our accounting department keeps the books on probably a little over 1,600 of our 3,000 dentists. So that probably has another 60 to 70 employees. We're probably one of the largest CPA firms in the nation that actually does accounting, as opposed to, actually do their monthly books. So between that, those businesses are substantial. They probably generate 25% of the revenue of Cain Watters. Cain Watters is blessed. We're now in the top 90 largest CPA firms based on revenue, not just based on AUM. And but we're all in one location. We're not in multiple locations. Of the top 200 CPA firms, we're the only CPA firm that's not associated with any other CPA firm. If you were to look at that has an affiliation, we're separate all by ourselves, and we're in only one location. And our clients come see us once a year, and they spend all day, and then we regularly monitor them and work with them. One of the things we've really invested in is technology. We have very significant investment in technology. So we've created a situation where we're more accessible over the internet than the CPA that's 2 blocks down the street. So when our dentist goes in to see their banker, they could go online, pull up their tax return, pull up their accounting, interact. They can pull up their current financial plan based on our software, and they could get a real-time update tied into all their investment accounts that shows them exactly financially what their balance sheet is, where things are. And that creates an interactive connectivity that is very important to overcome the distance that we have with clients in all 50 states.
Wow. And let me ask you this: have you guys grown the company all organically, or was there inorganic acquisitions in there as well?
Well, that's interesting, because we made our first acquisition as a partnership 2 months ago. Wow. And it's an affiliate that's in the field of dentistry, based in Salt Lake City. And they have only as clients orthodontists, about 200 orthodontists. We have probably 450, 500. We acquired them, and they've never done financial planning or tax preparation. They just do accounting. And the problem we have is that's the hardest thing for us to grow the business, is finding qualified talent. So by acquiring them and their systems for doing the accounting, this was very valuable. Now we're starting to add financial planning to their clientele, which is not ours. We're helping them integrate in their accounting with our accounting group. And we're doing financial planning and trying to work on obtaining their assets under management, which their dentists have. One of our businesses is actually called 7 Pillars. That's a business that negotiates the sale of dental practices to private equity. which is a very substantial business. It probably, separate from Cain Watters, generates, I don't know, $10 million of EBITDA all by itself. But many of those clients are oral surgeons or orthodontists. So it was a strategic acquisition on our part because it gave us access to people that are most likely to sell in the dental space their business to private equity. So it was a good strategic investment, and the partners there are very excited. We're excited to have them. The transaction was almost all for equity, so there's not a lot of cash that parted hands, which is always good. And the upside for the owners, which are young, they're all under 40, is substantial. So that's how that transaction case. That's our first attempt. That's not included in, I don't know the exact numbers this year. I think, our overall, I don't know what's appropriate or not, but our overall revenue, it's listed, in the top 100 CPA firms. So it's not like, you can't go find it. But our overall revenue this year is projected to be 75 to 80 million bucks as a CPA firm, which, is pretty crazy when you start in a room by yourself, right? We have beautiful offices, 60,000 square feet here. That's the background is our main lobby. And, I ride up the elevator with my employees and, identify who they are because a lot of times 7 a.m. in the morning, that's the only people coming up here. And, I ask them, what they do, and they tell me, and I said, oh, so you're doing this. And they always are surprised. They go, well, how do you know that? And I said, well, who do you think did it before you? So, when you're the jack of all trades, and remember, I didn't have 6 employees till 10 years into the business. So this is like it grew kind of slow, and then, you keep adding and you make a lot of mistakes and you back it up. But, the best thing we've got is we're blessed with, like one of the employees sitting with me right here, blessed with smart, really driven, happy people that work hard and want to serve others.
And so, in you saying that you guys have 12 or 13 partners there, were partners given equity after being there for a certain amount of time?
Well, my original partner, Mike Watters, has been retired 12 years. He and I worked at Pete Mark back in 1981 together. That's how we became partners. He was given equity. All the equity thereafter, and originally in 2008, I had 6 people join me as partners and my partner, and they bought in, they wrote checks. And then since then, we now have a situation where we've added partners. We've carried a note with them, and they've paid over time their share of the note. And then we work in a traditional methodology. We issue units, and we split the profits based on units. And those units you earn in as you have longevity. So you earn your units over time, and their units create more profit. We have base salaries for everyone. And those base salaries are set for a partner somewhat higher than if you were a planner. So let's say you're a non-partner. I'll just pull some numbers out of the air. These aren't accurate, but let's say you make $400,000 a year as a planner, and that's not an unreasonable number. You have 100 clients. We charge $12,000 a year per client. You're generating 1.2 million. You generate accounting, you generate tax, you generate AUM. And out of that, our compensation formula is somewhere between 28 to 33%. So they get paid, but when you make partner, we make sure that you have a pay that's above what you would make running your own client book to incentivize people. And then as the business grows and as you earn more units, you share in the profits in excess of what we pay ourselves as guaranteed payments. So I have no idea if that's too much detail. I don't think we did a lot of research on that. I don't think that's particularly unusual compared to other CPA firms. You may have been talking to lots of other people, but I think that's pretty normal. I think what's unusual about our circumstance is our compensation per planner and per partner is considerably higher than any of the big 4 accounting firms of what they pay their partners. So it's a very attractive career path. And, we have systems and processes that we expect our planners to adhere to, from a compliance point of view and our point of view about how we treat people and stuff like that. But, it's kind of interesting. In a way, you get to run your own book of business, and we don't cram down your throat. Like, for example, we have a rule. We have clients, and they do not have to be AUM customers. We don't insist upon that. If they are successfully obtaining their financial plan elsewhere, that's great. What we have done, and this is one of your questions that you had, is that what we have done is we've always, and I know this sounds cliche, we've always put the client first and their needs, which means if they're happy with their current advisor that does their taxes, great. If they have a great bookkeeper, fine. If they're happy with their investment advisor, that's okay too. What we do is we provide systems and processes that if those people somehow go away, retire, fail, we're here and we're not afraid to present to our clients, here's what we do and here's how we could serve you. And so we have a long-term attitude about the relationship. We take lots of dentists straight out of school. We speak in probably 30 of the 60 dental schools, which is an accomplishment because they generally don't let you in because they're afraid you're going to sell them something. But what we go and speak to them about is, how do you get a job? What's the job market? How do you associate? How do you become a partner? What is your perspective? So we have a database. I don't know, it probably exceeds people in the last 10 years, probably over 8,000 young dentists that are looking for jobs, and we build those relationships. And what we do is we have a long-term point of view about, well, we're here to serve you when you're ready to be served at whatever level you need. And so we have all kinds of different levels of service for those people.
Wow.
Thank you.
I mean, it's clearly evident that your firm's success is really rooted to the commitment and excellence and innovation within your client base. I'm sure within your 40 years of it, do you have a specific client story where you really felt like your approach at your firm made a significant impact in your client's life?
Well, I had one that just came up last week that I had been informed about. We have a public charity we started called the 3-to-1 Foundation, where we teach kids, mostly in Dallas, mostly underprivileged people. And this year we'll probably have 2,500 kids in high school or college. Many of them are minorities, Hispanic, Black. We support that. We give scholarships to those kids. So I was teaching at that course. And my longtime partner, Tony Lee, one of my female partners, she was my assistant for, years and years, but took over my client base originally. She came to me and she said, do you remember Dr. So-and-so and so? Of course I do. Do you remember her mother that came to you in 2001? And I said, yeah. And we'll keep the names to ourselves. But do you recall back then the estate law was the maximum that you could have her give away into trust so that it would grow outside of her estate? And I said, no, how much was that in 2001? It was $600,000. And you sat down with her husband had recently died. She was in her 60s or 65, almost 70. It's a very difficult conversation when you don't have a relationship with someone and their children who are your clients for a long time bring their parent. So I sat down with her at length and we had probably a 10-hour conversation, and I convinced her that it was going to be okay because I kept running the numbers for her if she could give away some of her wealth. So she did. And she lived into her mid-90s. She died in February. And my longtime partner just had a meeting with them. And this lady's trust, which we put $600,000 into, outside of her estate now, and we helped with investing it, et cetera. It grew to $26 million.
Wow. From 600,000 to 26 million?
Yes, in 23 years.
That is phenomenal.
So can you imagine, even though the estate law now allows you to shelter, 17 million, something ridiculous like that, that if she had, and not to speak out of school, but when she died, she only had $3 million in her estate. $26 million was outside the estate. So if you do the math, we saved her about 10 million, the family, about $10 million in estate tax. So needless to say, that relationship, which goes back for me almost 30 years, her husband's a dentist, my client. And this is my client's wife's mother that we're talking about.
Mhm.
I mean, I would say our relationship is intact, and we are important advisors to them. Would you say so? Anyway, so that's a story, if you like, one just that I just had. But we have lots of stories, hundreds of people, and we have hundreds of people that are now retired. So of course, figuring out their safe withdrawal rate, figuring out how to invest their money, which I would point out. One of the things we did way different than most people, we never approached investing money to see if we could beat the market or beat other advisors. Or what we did is we always used a risk adjusted approach to investing. And our attitude is, particularly we get someone young and we save a lot of money because they have the earning power, that they're already going to be wealthy if, let's say, use an adage, if they keep the ball down the middle of the fairway. And so we always invested our clients' money based on their financial plan of trying to reach the target return that allows them to achieve what they want in retirement, not trying to beat the market. So that's just a different approach, because they're always bombarded, especially dentists, with people coming up and saying, oh, look, I did better than your investment advisor. I did this, I did that. But, when you train your client to really understand, which I think education is the key to success in this business, that when you train your client to understand what their goals are and make them understand that they're achieving those goals and they're on target. But, money goes up and down. It's not a straight line. But if over time they see that they're achieving their financial plan, they don't have to take that undue risk. Now, if they're way in excess of their financial plan and they want to take some of their money and take more risk with it, we have models and approaches to do all that. And we could do that, but we don't want them to ever endanger the base amount of money that's going to allow them to live the life that they always imagined. So, it's a different way to invest money. And starting in 87, when I went out and started and I attracted my first money manager, my lecture back then was targeted weighted approach to investing money. In other words, how I did the asset allocation was based upon, safe withdrawal rates, Ipsen data, 100-year trends, different investment classes, measuring how I would do the allocation so I could specify that allocation to specific client circumstances. So, it allows you, there's just no one cookie cutter. We probably have 20 plus models that generally people fit in. We do a risk analysis. We understand their plan. We then put that into that model. Many times they don't put all their money with us right away because, they're still doing something with someone else. We do that. We then take a look at where they have their money elsewhere with ours. We try to blend that into the target, into the allocation to make sure we're not misallocated. But over time, what happens, we get their assets. So it's a long-term approach, but it's based on serving the client. I don't know if that may ring true with many of your other interviews, but that's how we approach it.
And thank you for sharing. Probably the best client story I've ever heard, by the way.
Incredible.
Yeah, it's pretty incredible, don't you think?
Yeah. Wow.
So,
but the power of compounding, right?
Let me ask you this. What do you see as the future for, Cain Watters and Associates? Do you guys have a G2 in place? Where do you see the firm 5 to 10 years out from now?
Well, it's always a question. We have regularly people approaching us. And I think, not so much for our core business, which is kind of amazing. Our AUM, our fees are we're below market. Our advisory fee on AUM is like 55 basis points. So then you wrap that in with the cost of our managers. Many times our overall fee, all in, custody, managers, everything, is something and you go to our ADV fee, so I may be misquoted here, but somewhere, 1.3, 1 point, we try to keep it, and that's fully disclosed. You could go to the ADV and the websites and look us up, at Edgar and see our fees. But as we've reached now the growth where we have 4 billion in assets, we're getting a lot of more attention. So we probably get solicited, I'll be honest, once to twice a week. Someone want to talk to us about partnering or buying us. Bluntly, my partners, I'm kind of like semi-retired. So I make quite a bit of money. I mean, 7 digits. So do they. And, it's very hard. Many of them are 40 years of age. And when you're making a 7-digit number, someone has to write you a really big check to compensate you for the loss of your future earning power. So we don't know anyone's really willing to write that check, even though the trajectory of the growth of our assets is significant. And one of our secrets that's been really successful is our relationship with our client is not just based on their AUM. It's based on the total service of their needs in their financial plan, accounting, tax, how to transition their business, how to run their business, all the aspects of financial planning. And that's always been our focus. The AUM came after that. So the problem is we have 30, 40 planners that are not partners. They make a good income. We have 60, 80 young people that are working towards the goal of being a planner. There's no secret what our people make, which is always good to have full disclosure. It's kind of like, what are you working hard for? And so then the question becomes, how do we take a sum of money and yet then have all of our young people be then destined to only work for someone? Because, whoever buys you has to get an EBITDA, right? They have to get an earnings for the money they're about to stroke you. And this old saying goes, in the end, you always have to answer to the money, right? What we do right now is answer to our clients. If you take a bunch of money from someone, you got to answer to the money. And then all of a sudden, you take away the incentive for many of your younger people. Now, I'm not to say, I'm basically semi-retired. They owe me, I'm 67, they owe me till I'm 70, and I have a tail after that for 5 to 10 years on different business units and stuff. And we have another unit called Tectonic, which I don't have a tail on, I just own it. That's what owns our bank and our money management services and stuff. But the problem is what sum of money is someone going to write? And then how are you going to look the people in the eye that do a lot of the work? And how are you going to not incentivize them? So this is interesting for us. It's obviously an ongoing debate. I personally chose to allow the younger people, because on average, my partners are 15 years younger than me, to own the business and get the benefits of all the innovativeness and all their energy. Because, mark this down, Darrell Cain is not Cain Watters. Cain Watters is the people that work with it in their relationships with thousands of people. And you can't not acknowledge that. And you got to make sure you honor that. So that's the process. We're in a really good spot. People right now keep asking us, well, why don't you do something other than dentistry? Well, there's 150,000 dentists. Probably 15,000 of them are really successful. And we know that. We have a business called Elite Dental Alliance, which is like a Costco. It provides dental supplies and services to dentists. And we have like 5,000, 6,000 members there. So half of those people are not our clients. They just buy their services through us because they get a significant discount. They pay a membership fee like Costco, and then they get to buy stuff cheaper than they could buy it elsewhere. But bottom line is, we only got 3,000 dentists. Our target market still has like 12,000 dentists to go. So, in that one target, not that we're going to get them all, but, we're experiencing 10 to 20% per annum growth of our revenue. And so that's kind of where we are. And that's what we see. Now, during COVID, one of the things that really bumped us up and accelerated the business was we did a lot of blogs interpreting all the rules about the PPP loans and owning an interest in a bank. We were able to hook our dentist up with the bank to give them the loans and generate the loans. So we generated that with thousands of our clients. We had on our blogs, which if you went to our website, I assume it's still historically recorded. We would record every time the government put out a new issue or law. We would, huddle together and take that apart in 48 hours and then issue a webinar of giving advice. What's interesting about that, we had 3,000 clients, but every time we issued that, we'd have 50 to 70,000 hits on the interview where we gave advice to people that weren't our clients, telling them how they should handle it. Should you lay off your people? Should you not? Should you get state unemployment? Whatever. And, this generated a lot of people coming to us, which really kind of upped our growth pattern of our clients. We probably, going into COVID, probably had 1,500 clients. So now 5 years later, we have 3,000. Not all those people stuck with us because they were, coming to us just for advice. But that was really a real growth indicator. And what that was about is we interpreted the law, gave people advice, which a lot of people wouldn't give advice because they were afraid. You had to make calls. Do you do this? Do you do that? Do you do this? And so we spent a lot of energy on that. And a lot of other people in our profession, dentistry and elsewhere, gave other advice than our advice, but our advice mostly proved out to be correct. And we had a big following from that. So that was a real growth pattern.
Thank you.
Thank you. So let's shift our focus on investments, Darrell. What investments or sectors are you most excited about right now? Any emerging trends or opportunities that you believe hold a significant potential for future wealth creation?
Well, we have, as I mentioned, a lot of dentists that are selling out to private equity. So as opposed to the 30 prior years where it's kind of like hitting singles, our clients could save 50, 100,000 a year. We started generating through these private equity deals, people getting amazing sums of money, 10 million, 15 million, 20 million. In a lump sum. All of a sudden, our normal asset allocation between the 15 or 20 models we had, the 25 or 30 different money managers that we hired, we hired a money manager for every occasion. I used to tease people. It says, I have more money managers than golf clubs. I also have more attorneys than golf clubs, so I got an attorney for every shot, right? So that's my career the last 10 years was compliance, different government agencies, banking, attorneys, things like that. So what we've really done since then as we get those sums of money, we have really, and I don't know if the word's the right word for it, but we have really delved into creating sleeves of investments with private equity. Sometimes the KKRs of the world, the Apollos, some of the real estate people, here in Dallas, people that have all kinds of alternative, and I don't like the word alternative, but they have strategies that are not just stocks and bonds. And, we do complex strategies where we invest their money and generate losses, but yet overall their account doesn't go down. We have lots of tax harvesting. So I would say the area that we have put a lot of energy into, and you got to understand how Cain Watters is set up. Cain Watters has an investment committee, and I have smart partners in investments. I have a CIO. He's one of my partners. He's younger. About 15 years ago, I determined that to take people that are really good at investments and put them into partnership with a bunch of CPAs was not going to work. Those two are like oil and vinegar. They have different risk attitudes. They have different experiences. So what I did is I created a separate firm, which is now an affiliate of ours, that's now known as Tectonic Advisors. And Tectonic is where I went and hired all the people to do the due diligence on money managers, on private equity firms, similar to what you would do. And let's just, pull out something from the past. You're all familiar with InvestNet. InvestNet, I knew the original partners there before they went public. They would go do due diligence and then give you different money managers to choose from. Well, I wanted to do is go replicate that process. So in the end, Tectonic and its people, probably 20 or 30 full-time people that do all the due diligence, track the managers, know what's going on, help us figure out who to hire, who to fire. One of my real issues when I started in 87 is I had one money manager. Well, he grew, but as time went on, he was not good in all facets of the investment spectrum. Who can be? So I had a hard time when I had to fire him because my clients didn't understand that, because what I wanted to do is to build a system where I could, and it sounds terrible, but I wanted to be able to take the manager if he was underperforming or if he had a change of how he viewed the world. I mean, you have to get close to these people to kind of know how they think. And if I needed to take them out behind the barn and shoot them and replace them, the system was still in place, but the manager was interchangeable, right? And I told you that sounded horrible, but it's kind of like I need to replace this person.
Just like
making that decision is very hard, especially since we always spent the time to build a relationship. So we would know them because, sometimes I'll give you an example. So I had a manager, the second Iraq war. When was that? 2003 with the second George Bush.
Gotcha. Yeah.
Yeah. And it's like all of a sudden he's taking all of our money and, I don't have discretion over people's account. He takes all the money and he's starting to put it all on the sidelines. And so I called him. I said, "What's going on?" He says, "Well, I'm just worried about what's going to happen in the world." I said, of course, we're worried about weapons of mass destruction. Of course, we found out that wasn't so. I said to him, "So you think we're going to lose the war?" He had no answer, right? And so it's like sometimes you got to know these people, right? And you got to know what their attitudes are. And, and I'm not saying I always keep 100% invested, but generally, historically, over the 40 years of my experience, getting out of the market is not always a great idea, partially because you don't know when to get back into the market. Now, you could lessen your risk by changing your allocation, but you need to not because poor client, once they pull their money out, they don't know when to get back in. It goes up and what if I get in now? It goes down. I mean, you keep it in the system and you allocate based on risk. So anyway, I needed a system where I could change that around. That's the same thing we have now. We have money. It used to be with TD Ameritrade. Now it's with Schwab in different pools and processes. We still have common pooled trust funds with our bank. I don't know, 1.5 billion or 2 billion there. We have mostly that in the area of pension money. We have the ability to move the managers in and out. We watch their relative performance against their benchmark. We don't expect them to make the highest return. We expect them to make a consistent return. We do a lot of metrics where we stress test for the downside. Because I said, it's not like I'm taking a client that can't save money and a client that they got to, roll all the dice as if this is the only thing they got. Instead, with the systematic process of accumulating money, that we want to hire managers that reflect that. So I don't know if I answer your question, but I would say delving into private equity, the larger our assets under management have become, which is interesting because our broker dealer and our other assets outside of Cain Watters that does all this due diligence, their assets are about another 4 billion. So on a combined basis, when you got $8 billion, you basically could get an interview with anyone that you want to talk to, right? Because they're interested in that. So that's now, when I started, 40 years ago, when my first client only had 50 grand, it wasn't that way for me. So again, how people view the world is way different, right?
Right. Wow. Well, that's fascinating. Thank you so much for elaborating on that with us. So Unfortunately, I think that's the amount of time we have today, Darrell. I think it's time to wrap up, but thank you so much for joining us today and sharing your wealth of knowledge and insights with us and our audience. It's been such a pleasure having you on the show and hearing your fascinating story. You've achieved so much in your life, and we're excited to see what more is to come with you and Cain Watters. So thank you so much.
Yeah, I'm sorry I wandered around a lot, so I didn't get all to your questions,
Oh,
but
you're great.
hopefully I was okay.
It was a delight. Thank you so much.
Well, thank you.
And to our audience, thanks so much for tuning in to another episode of the What Matters podcast. Join us next time for more insightful conversations on finance and wealth management. Until next time, take care, everyone.